Hello everyone and welcome to our YouTube live. And what I'm going to do is just go through what the Fed has said and I think talk through some of the consequences, and also I'm trying to keep it short, right? But we will have questions at the end. If people are wondering about our normal Q&A session that we have once a month, it's going to be on the 9th. So that's next Thursday. So, we'll have an hour together then and you can ask me questions about general investing. We will have a Q&A at the end of this one. And so if you do have questions, just save it for the end. So let me just fire up these slides and then we can talk through this. Right. Teddy's run off because he was scared because I had my shirt on. So it's something he doesn't generally like. Maybe he'll join us later. Brilliant. So in terms of the policy change, no surprises, right? So it was a 25 basis point increase, that's 0.25%. And the meeting probabilities, which were backed out of the Fed funds futures market before this, were reflecting that. So there was a 99% probability when I checked this morning that we were going to see a 25 basis point increase. And of course, that's what happened. And so far through this kind of hiking cycle, the only surprises came at the beginning when they really stepped up the pace of rate increases. Since then, they've been pretty much in line with what the Fed funds futures expect. So what they were expecting this morning was 25 basis points today, which happened, but they also expect 25 basis points at the next meeting, which is in March. Now, at that meeting, we're going to get an update of the summary of economic projections, where each of the committee members from the Federal Open Markets Committee adds one dot into the dot plot for various macroeconomic variables like expected growth, unemployment, PCE inflation, which is, remember, how the Fed sets its target, but also whether they're expecting to see a recession or not. So the last time they did this, they weren't expecting a recession. It was like 0.5% above inflation. They were expecting unemployment to increase, and they were expecting inflation to fall by the end of this year to somewhere around 3.5%. And consequently, they weren't expecting rates to be cut over the course of this year. So based on their previous projections, when they last updated the dot plots in December last year, they're not expecting to cut rates this year. And if you look through the next few meetings, so that's in May, June, July, and then finally we get to September. September will be the last one where they don't do anything according to markets. In November, what markets are expecting is the first rate cut. Now, Powell talked about this. He said that this was because markets have a different expectation about inflation. Markets expect that inflation will come down more quickly than the Fed does. Now, who would I trust? Hard to say. I mean, neither of them are right, probably. But probably the Fed is quite well informed about inflation. They just look at the data like everyone else, but they do have a lot of very skilled people looking at it. And what they expect is inflation will probably stay fairly sticky. And I'll talk about the components in a minute that are sticky, which is talked about before. But anyway, markets expecting the first rate cut in November, but the Fed not. Probably if there are cuts, they'll come next year. Right. If you actually look, there was a tweet by Nick Timraus of the Wall Street Journal where he kind of shows which statement items have changed in the policy statement that comes out half an hour before the meeting. And there isn't a huge amount of change in the language. Obviously, the date changed, but they are talking about things like upward pressure on inflation was changed to elevated, and slight change in the wording about the war in Ukraine. Obviously, the Fed funds rate changed because they changed the rate, and all the stuff about policy staying high for some period of time, all of that's there. So no huge change in the actual language of the statement. There was a small thing about COVID, which got a laugh because, of course, Jerome Powell's just had COVID. So he's very well aware that it's still a problem. But his point was that it's not an economic risk anymore. People are just getting on with their lives and kind of not really affected in terms of their daily work by COVID any longer. So that's why it's been taken out of the statement. And obviously there's been a change in the people who are voting because the FOMC committee members change over time. Now, one of the things that is very important is that it's not just about interest rates. So although people aren't talking about it much anymore, the size of the Fed's balance sheet is still, $8.5 trillion, but they're shrinking it at a very accelerated pace, right? So $60 billion per month being put back into the Treasury's coffers in Treasuries. So as the bonds mature, instead of reinvesting all of the coupons and principal payments, they now take off 60 billion per month, and then anything that's left, they just reinvest again. And then in mortgage-backed securities, they're doing 35 billion per month. If you add those up and turn it into an annual figure, it's slowing down at about just over 1 trillion per year. So probably we'd expect this to reach something like 8 trillion by the end of this year. And who knows what effect that's going to have. People don't really understand the effects of shrinking the balance sheet. But this is real quantitative tightening combined with monetary policy tightening. So I think people underestimate how important this is, although it's not talked about much anymore. Don't know why. Right, there were some funny tweets around, so I thought I'd just share these because, well, they're pretty good. Liquidity came out with this one, which said, it shows Jerome Powell as a Terminator, and then it shows this poor little girl hiding under a desk from the Terminator, and she's the US economy. Yeah, very funny. And the next one is a picture of Jerome Powell saying, "Calm down, I just want you to lose your job." Not so funny if you do lose your job, of course. So that brings us on to the tight labour market, and this is one of the problems at the moment, which is we've just had the latest JOLTS data, as it's called, and what this tells us is the number of unfilled job vacancies which are out there, and if we divide that by the number of unemployed persons, it's still 1.8. So for a while it came down, now it's gone back up, and in fact, based on the latest data, I think that's gone back up to 1.9. So that was on the basis of this morning's data. I think it was today or yesterday we got the JOLTS data. So still a very tight labour market. Lots of jobs available for every person that's looking for work. And that means there's a kind of inflationary environment. Now you'll hear a lot of news about tech layoffs. Everybody's talking about how Google's laying people off. Maybe Apple hasn't, but many other tech companies have. Everybody focuses on that, but in fact in other parts of the economy, like the industrial parts of the economy, things like the automobile industry, there's actually very rapid hiring of people. So there's a kind of jobs boom in those sectors. And nobody pays attention to those because they're not sexy sectors. So just remember that there's more to the economy than tech. And in those sectors, there's still very brisk hiring. And if you look at the non-farm payrolls, you can see that it is, so this is the number of jobs which is added to the US economy every month. It is slowing down, and the latest number was 223,000, just to replace or just to fill roles as people come out of college or come out of school. You need 100,000 new jobs created. We're still creating twice as many jobs per month than is absolutely required. So there's still a huge amount of job creation. And this shows the Fed that there's a mismatch between demand for labour and supply of labour, which is inflationary. So that's not good for the Fed as far as it's concerned. So still a tight labour market and still a problem with potentially inflationary situation there. Now the other point that Jerome Powell said this time, which was quite different to previous meetings, is that disinflation has definitely started. So what do we mean by that? Well, remember that inflation is a year-on-year change in prices. So we take the price of eggs today, we divide it by the price of eggs last year, and it's the rate of increase. Now, disinflation is when the rate of that inflation increase slows down. So if inflation was 6% last month and it's 5% this month, that's disinflation. And so that's exactly what we see here. If we look at CPI inflation, consumer price inflation in the US, it peaked several prints ago, so that was several months ago, and it's been falling since. And the same's true if you take out food and energy prices to create this less volatile inflation measure for core inflation. That's also pretty clearly starting to fall. So disinflation, the Fed has now announced, has started, and that's great news. But as you can see, they've still got a long way to go. We're still way above their 2% target. If you look at the actual annual changes, so that's the panel you see on the left, and the monthly changes, which is the panel you see on the right, notice how the monthly changes show some really big falls. So if you look at fuel oil and other fuels, remember that's what spiked at the beginning of this inflation spike. Those have now gone into deflation, deep deflation, about 12% for fuel oil. For gasoline, 9%. And remember, that's a really visible inflation number. People always talk about gas prices, and now they can see them coming down on a monthly basis by a big chunk, right? 10% is not something that's small. Airline fares as well coming down. There are still some prices going up, like gas prices over on a monthly basis still going up, shelter still going up, electricity still going up, rent still going up. But generally, we are seeing a kind of slowdown. And even on a year-on-year basis now, gasoline is falling. So we're seeing disinflation and, in fact, deflation for gasoline on a year-on-year basis. Same for used cars and trucks, because those supply chain bottlenecks are very much eased now. So that's good news. However, if you look at PCE inflation, this is, remember, the Fed's preferred measure and its targets based on PCE inflation. Core PCE inflation has also fallen since the beginning of last year, and the same's true of PCE inflation, headline PCE, personal consumption expenditures inflation. But Powell breaks it down to three components. Goods, so this is the kind of stuff that you go out into the shops and buy. That's very clearly gone into, oh, I had a picture of that. I thought I did. Yeah, here we go. So this is goods inflation, which is a subcomponent of PCE inflation, and that very quickly went into reverse. The Fed actually expected it would happen sometime in 2021. In fact, it took until 2022. But that element was based on supply chain disruption, and now that's gone into deflation. So on a year-on-year basis, it's gone negative. The two other components are housing services. So there we're seeing that leases are now turning softer. That's going to carry on rising for a few months, but the Fed now expects that in the middle of this year, that will also start slowing down. We'll see disinflation there too. The really big chunky component of PCE inflation, which is resilient to monetary policy so far, it hasn't shown any signs of disinflation, and it makes up, I think he said it was 60% of PCE's basket of goods and services is non-housing services, core services. So this is things like restaurants, transportation and financial services. Those haven't really shown much sign of disinflation at all. And that's based on labour costs. So the fact that the labour market is still very tight means that policy hasn't reached that part of inflation. And that's the component which is turning out to be very sticky and which will probably keep rates high for, a good chunk of this year, probably into early next year, because that's the component which is proving to be very tricky to get rid of. However, what's good is that if you look at expectations about inflation, whether it's surveys of companies or surveys of people or markets, here we're looking at 5-year ahead, 5-year inflation expectations backed out of the inflation swaps market, you can see that that's stayed fairly well anchored. It hasn't spiked hugely. The worrying time was here in 2022. in spring of 2022 when it did seem to be going up rapidly. But since then, that's pretty much come back down, and it's not much above the 2% target. So one of the things that Powell really stressed is that if people don't expect inflation to be super high, then you don't get anchoring of expectations, and actually makes it much easier to combat inflation. Because if you're thinking about your wage negotiations, if you're expecting inflation to be 5% or 10% forever, well, you're going to insist on 10% wage increases. You don't want to have negative real wage growth. But as inflation comes down, that's less discussed about. So it's easier to get inflation down when expectations are anchored, and expectations are anchored. So that's good news for the Fed. So we are starting to see demand fall in certain rate sensitive sectors. And the one everyone thinks about, of course, is housing. And if you look at house prices in the US, the Case-Shiller index, or if you look at the average sale price for new houses, both of those have pretty much topped in the middle of 2022, and we're seeing those come down. But still, they're 40% higher than they were at the beginning of 2020. So potentially that sector, the housing sector, could weaken further. It's quite likely to do, in fact. And if we break it down by city in America, the Case-Shiller index is broken down by city. You can see that San Francisco is the one that's really started to fall quite a lot relative to its peak. And it's actually below where it was at the beginning of 2022. Other towns like LA, Portland, Minneapolis, Denver seem to have slowed down their rate of decrease, if you like. But clearly the monetary policy is having a negative cooling effect, a reduction in demand in this sector because it is rate sensitive. Now, if you look at the new houses which are being built, so these are called new starts, housing starts, those have also started to fall. Because if you're a housing developer and you see that house prices are starting to fall, I guess there's clearly less demand for houses. So you're going to stop, or at least reduce the rate of house building. So there's no question the housing sector is starting to see a fall in demand. Now, one of the points that Powell was stressing, and in fact he came out and said it, is that financial conditions are tightening. So what does that mean in practice? Well, financial conditions is, for example, if you're a company looking for a loan, how easy is it to get a loan? If it's difficult, then that's because of tighter financial conditions. Or it might be harder to get a mortgage, for example, if you're buying a house. So there are various measures that you can look at which measure financial conditions. And there is a financial conditions index created by the Chicago Fed. So here's the kind of headline conditions index. When it goes red, that's when conditions are tight. So you can see in 2020 with the pandemic, suddenly conditions got very tight. And that slows down the economy. And that was worrying at the time. And that's why the Fed loosened policy in order to loosen financial conditions. Now, since they've been raising rates, you can see that financial conditions did tighten. They were moving upwards into red territory. But look at what happened towards the end of 2022. There's been a reversal. So in fact, the conditions are getting looser. And that's true of all three components, subcomponents of this financial conditions index: credit, risk, and leverage. So it's pretty clear that what Powell said is not true, at least by this measure, which is created by one of the Fed banks, the Chicago Fed. So I'm not convinced that financial conditions are getting tighter for the general US economy. If you look at equity markets as well, they've been soaring upwards recently, with all of the kind of flight to shite type stocks really rallying quickly, and cryptocurrency and meme stocks and ARK-K, for example, Cathie Wood's fund. So all of that kind of growthy, junky stuff is back on the go, as it were, as if the Fed's going to reduce rates. But that's clearly not going to happen because of this kind of core inflation part. Now, one of the interesting questions was about the debt ceiling and what the Fed could do about the debt ceiling, because I'm about to publish a video about the debt ceiling, so it's at the forefront of my mind as well. That's coming out this Saturday, unless you're a member, because then you could watch it right now. But anyway, the statement that Pal made about that was interesting, and it was a prepared statement, right? So he had to be really careful. I feel like I have to say this. There's only one way forward here, and that's for Congress to raise the debt ceiling so that the US government can pay all of its obligations when due. And any deviations from that path would be highly risky. And that no one should assume that the Fed can protect the economy from the consequence of failing to act in a timely manner. So essentially, Powell's saying, if you break it, we can't fix it. So if the US government doesn't raise the debt ceiling, it's going to be catastrophic. So the Fed's not going to be able to fix it. They can help, they can ease conditions, but that would be abysmal. So let's just hope that doesn't happen. So that's it. And if you want to ask any questions, please do. And I'll switch back to me and I'll have a look at the document that Laura's preparing. I'm going to have a drink. So do ask some questions if you like. And obviously, if you're a member, if you're one of our supporters on YouTube, you have a little crown next to your name and Laura will push your question to the front of the queue. Also, if you do a super chat, obviously it helps us financially. We've just moved into a new house and we ticked the top of the market, so we've got to eat. So please do a super chat. It helps us. So yeah. Oh, here we go. So Laura's typing something. While she does that, let me just have a quick look at your comments. Somebody's saying everyone's leaving California. Pity, I love California. I lived there for a long time as a boy, and a beautiful place. I loved LA. I loved all the kind of niche places in LA. There's some beautiful places. Where are we going with the question? Oh, Laura stopped typing. Right, so I'm going to answer some of your questions now. Somebody's saying, how's your doggy? Should we summon Teddy while we wait for a question? Okay, so here's his treat box. I'm going to rattle this and we'll see how long it takes him to come. Teddy. Treat. Teddy. I'll take the lid off again. That usually triggers him. Teddy. Ted. Oh, yes. Oh, hello. Fancy seeing you up here, Ted. Look what Daddy's got. Oh, yeah. Oh, he loves those. Is that all? I have another one. Yeah, so do ask a question and super chat would be great. Okay, I can see some questions now. We have one more treat for Ted. There you go. Oh, yes. Very good. Well done, sausage. Right. Back to your questions. Right, so let's answer one of yours. The statement was hawkish, and why did the market go up during his speech? Yeah, let's have a look. So we'll have a look at Koifin. And I'll share my screen again. Oh, they've got a mobile app now. Cool. So here we go. 1 month, 5 days. Let's have a look at market movements. Yeah. So Nasdaq moved up a lot. S&P moved up a lot, and government bonds also increased in price. So yeah, I mean, it was kind of, I didn't see that as a particularly dovish meeting, not at all. You know, he was pretty clear that they're going to raise more carefully now, but everybody kind of knew that. So I don't think there was any kind of new information there. So I wouldn't read too much into the market moves. I mean, it was certainly a huge move. So for a one-day move, that's pretty chunky. 2.2 on the Nasdaq, 1 on the S&P, and bonds moving up as well. So yeah, I mean, maybe it was because he said, we've entered a disinflationary period. Maybe that was what. What do you think, Ted? Was that disinflation? Yeah, that's what we think. So, you finished? Do you want a drink of water? They make you thirsty, don't they? Yeah, so you go and get a drink of water. So I think that's probably it. Just the fact that he announced that disinflation has started, definitely, and that's positive news, no question. But he was very clear. Markets have probably got ahead of the Fed's expectations for inflation, and the Fed is still expecting inflation to be quite sticky, particularly that non-housing core PCE services, which is a bit of a mouthful, which you can't find on any database I can find anyway. But it's still, I think it wasn't particularly dovish. So I'd expect that this rally would probably fade. That would be my expectation. Back to Laura's document, and there is a super chat. Thank you very much. And that was the question. So, what has caused the latest market rally? Yeah, I think that's probably it. I mean, just reading through the comments, reading through the... I listened to the meeting almost twice before this live stream, or at least the important bits, and there was nothing really that was dovish in it, I don't think. So, yeah, I think it was just the disinflationary comment, and that is a definite positive. But certainly in terms of forward guidance, I don't think a lot changed. The reason why they're increasing in 25 basis point increments now is because they're just feeling their way gently now to try and they're kind of fine-tuning their policy, was the way Powell put it. So they've done all the really aggressive stuff, that's behind them. They've raised rates by 4.5%, and now they're just kind of fine-tuning to find that terminal point, which is sufficiently restrictive. And although he said that financial conditions are now tighter, I think if you actually look at financial conditions, it's pretty clear that they're not responding as if they are tighter. We are seeing things like the corporate bond market with super tight credit spreads. That doesn't reflect a market where credit conditions are tightening. You just see how credit spreads have tightened over the last, 3 months, 4 months. So let's have a look at those just so I can show you. Fred, what should we look at? Triple B spread. Yeah, that'll do. So triple B is the lowest notch, just above junk. Hope you can see that. No, you can't. There we go. I'll move my face. Yeah, so here we go. So this is where we were in the big sell-off during the pandemic. The triple B credit spread increased to 5%. That's tightening conditions. But since then, it's got super tight. All right, so it's gone back down to 1.1, which is below the long-term average. Then it widened for a bit in 2022. But since its peak in October in 2022, there's been a huge amount of tightening from 2% down to 1.6. Now, if there's a recession, you'd expect that to blow out to, 4 or 5%, as it did in 2020. So there's no pricing in of a recession or higher default rates at the moment. So that's not financial conditions tightening, certainly not in the credit market. So, I don't think the Fed is happy with financial conditions loosening, and I think they'll keep their monetary policy aggressive and make it more aggressive while these loose conditions continue. So I think that's just a kind of temporary blip. I expect markets will probably sell off tomorrow, but who knows? But there was not much that was dovish about that meeting today. But anyway, the super chat. Thank you, Ray. We appreciate it, and thank you for your question. Another question from Aspen Tech, who says Oxford Economics thinks Poland will grow faster than Turkey this year. I've got no idea whether Poland will grow faster than Turkey this year. But it's interesting. I mean, Turkey was one of the weird stories in equity last year. It was the best performing equity market in US dollars, in US dollar terms, because everybody's piling into the Turkish equity market just to preserve the value of their capital in the domestic market. And of course, other people have noticed the trend, and foreign investors have also started piling into the Turkish market. But that's kind of slowed down this year. It's been in reverse for a while. But that was a huge story of last year. But yeah, I mean, I don't have an opinion on Poland versus Turkey, really. I mean, Turkey is such a difficult country to invest in because of its huge inflation of more than 80%. You know, I think that's any kind of rational basis, you wouldn't invest in that. So just a few more questions. Mike Marino says, what a gorgeous dog. Thank you very much, Mike. Alex D says, is now a good time to re-enter the S&P 500? Well, let's have a look at valuations, because that's kind of interesting. So if you're a member of PensionCraft, you get these trackers, and one of them is looking at valuations. So let's have a look. So this is for members only, but let's have a look at fair value. And actually, let's look at forward valuation for the S&P. That's more relevant. Stock valuation. There we go. And I'll maximize this. So the idea here is that this tab's supposed to show you when equity is cheap or expensive. So let's have a quick look at the S&P to see where we stand eventually. Oh yeah, this is not good. Yeah, just talk amongst yourselves, it's fine. But what this shows you is the forward price to earnings ratio for the S&P 500. And what's really important is that for the US, it's actually at the 10-year average. So is it super expensive or super cheap? Neither. You know, it's just not egregiously expensive like it used to be. So I think that's a much better indicator to look at than, say, something like you know, whether markets have fallen by a certain percentage. Because if you actually look at the best predictors of 5-10-year returns, it is this valuation. So the forward price to earnings ratio is a fairly good measure because it looks at forecast earnings. And if those get downgraded downwards, then it adjusts accordingly. So it incorporates all the latest information. So as of yesterday, the S&P was at 40.77. And that was, you know, the 10-year average multiple was 4% below that. And you can see that it's actually got quite a bit more expensive since, you know, maybe August 2022. So I think at the moment, the US is still quite expensive relative to other countries. And that's why I think, you know, if I had a lump sum, I probably would be a little bit reluctant to invest in the US right now. A global index is probably better because the US, when it's expensive relative to other places, will usually underperform for the next 5-10 years. So usually you get these kind of lost decades when the US has been in a huge tear, like it was in 2000. You know, then we had a lost decade. The same thing happened in the 70s. So, you know, just be careful about piling into the S&P. Just because that's been the best market for the last 10 years probably doesn't mean it's going to be the best market for the next 10 years. In fact, the opposite. And the valuation, the relative valuation, is still not looking particularly favourable. And if you look at the excess Cape yield, since 1880 or 1870, it's been cheaper about 2/3 of the time, 63% of the time. And this measure actually looks at real interest rates and adjusts the expensiveness measure based on real interest rates. And even if you adjust for interest rates now being higher, it's still looking relatively expensive. So red is expensive, low is expensive on this graph, and you can see that it's just about to touch the 70th percentile here, which is the dashed red line. So pretty expensive. Everyone talks about Schiller Cape. That doesn't adjust for interest rates, and that's also looking expensive. But anyway, I think now, I mean, if you're going to be drip feeding, just carry on. You know, I am, and but if I had a big lump sum, I'd be a bit cautious about putting everything into the US. I'd probably go for a global index, or maybe even tilt away from the US if you're into that kind of thing. So let's have a look at your questions again. No super chats and no members asking questions. So I'll just answer one more question, because the idea of this is that it was supposed to be quick, right? So, oh yeah. So Royal Domi says, today Michael Burry tweeted sell. Do you think he's onto something? Well, I think he's right that there's too much euphoria in this market. You know, everybody's conditioned to think that the Fed's going to step in every time there's a problem. That just isn't true anymore. With inflation still being so high, the Fed's not going to run to the rescue unless there's a systemic problem. Like if the Treasury market seized up, yeah, the Fed would step in. But if markets fall, there's no Fed put that's going to save the day. So I think this, you know, we're in a very different boat than we were, you know, over the last 10 years in a way, when the Fed would have stepped in. So I'm not convinced that this rally is going to last. It'll probably be a long period of weakness, as earnings are going to be very disappointing. So I think this year is kind of characterized by a tug of war between weakening earnings. So profits are falling for S&P companies as margins get eroded. We saw this coming for a long time. I've been talking about this for a year, but eventually it's happened, and earnings are being downgraded. And at the same time, what's pulling in an upward direction is that inflation's falling and the Fed's slowing down its rate hikes. So I think those two are pulling in opposite directions over the course of this year. And certainly at the moment, what's winning the tug of war is falling inflation, because markets see that as a big positive, and they're kind of looking through this tough period. The economic data has been good, right? You've got high employment, low unemployment, inflation's falling. It looks like there might even be a soft landing. Whoever would have guessed that? And the Fed might not crash the economy in order to reduce demand. It could happen now. But even the Fed thinks that unemployment is going to increase significantly, and will probably lose about 1 million jobs, over 1 million jobs in the US over the course of this year. But that's just a forecast. They don't really know, of course. Anyway, I think we'll probably leave it there, because it's getting late. But anyway, thank you for joining us. As I say, we're going to have a live stream on the 9th. So please do join us for that. And you can ask any questions you like on that call. So that would be great if you could join us. Don't forget our membership. You can join us. Also like this, and because obviously that helps us too, and subscribe to our channel, because that way you won't miss any of our content, which I struggle to keep interesting and informative. And thank you all for joining us, and we'll see you maybe on the 9th. And do watch out for our video this Saturday, which is about the debt ceiling, which is quite a scary prospect. So bye everyone. And Teddy says goodbye as well. You're going to say goodbye with one more treat, Ted? One more? Oh, he's come out of his bed specially. There we are. Bye everyone. He's a good boy.